In this screencast, we will be looking at the petty cash fund. Firstly, we will begin by understanding what actually a petty cash fund is. Petty cash, or a petty cash fund, is a small amount of money available for paying small expenses without writing a check. These small expenses may include office supplies, mail services, and even food or coffee expenses. This petty cash is often held on a company credit card or even in a secure drawer, where one employee is designated as the custodian. The amount of petty cash will vary across companies. Accounting for petty cash can be broken into 3 steps: establishing the fund, making payments from the fund, and replenishing the fund. Step 1. A petty cash fund is established by writing a check for the amount of the fund, which is then cashed in and becomes the responsibility of a custodian. Once the fund is established, cash is used to pay for minor qualifying expenditures. And finally, once the fund has been used up, it must be replenished. And to replenish the fund, the remaining cash in the fund is counted and the business cashes a check for the amount that brings the total cash in the fund back to the original balance. We will now have a look at this example of step 1, establishing the petty cash fund. On February 1st, Lane Cove Pizzeria have cashed a $200 check for petty cash. We will start by recording the date of the transaction into the journal, February 1. Then we will debit and credit our 2 required accounts, being petty cash and cash. Firstly, our petty cash is classified as a current asset, which in this case is increasing, so we debit $200 to petty cash, and therefore will credit $200 to our cash. Notice there is no change in total assets yet, as no expenses have occurred outside of the business. Following the establishment of the fund, some may believe that we make journal entries when payments from petty cash are made. However, simply no records are created when these small purchases are made. This is an important note to remember. Now we look at replenishing the fund. Here we look at the petty cash fund replenishment report. The remaining cash in the fund is counted and the business cashes a check for the amount that brings the total cash in the fund back to the original balance. The receipts in the fund are then used as documentation for recording expenses. In this case, we minus $50 from our $200, meaning that we require $150 to replenish the fund. As shown in the receipts in the funds, they should equal the requested amounts needed to replenish the fund to its original amount, which in this example it does. The entry will increase the 3 expense accounts related to the expenditure and then decrease the cash account for the amount of the check. This same type of entry would be repeated each time the fund is replenished. Sometimes when the petty cash fund is replenished, the amount of cash needed for replenishment does not match the total receipts. Therefore, the discrepancy is charged to an account that is called the cash short and over account. In this example, the company has a discrepancy of $10 and we will need to record this in the journal entry. As you can see here, a cash short and over account is created and the discrepancy amount is added. Therefore, cash will match the starting amount. To finish off, petty cash is simply an amount of cash kept on hand to pay for minor expenditures. The 3 activities involved is establishing the fund, making payments from it, and finally replenishing the fund.